Alright, welcome back. Now, if you want to make consistent profits, you need consistent actions, right? And that starts with having a solid foundation for how you show up to the charts every single day, okay? Because the way we approach the markets when it comes to trading, and especially, in the one-on-ones that I do inside my community, it always starts with market structure, right? And that is what gives us the directional bias for the session. Now, market structure alone isn't the whole picture. Obviously, you have to combine it with other things, especially liquidity. But this is one of the biggest puzzle piece in understanding the direction, in understanding the bias, okay? Now, the next step, obviously, is understanding supply and demand, because we're not just buying just because, the market is going up, we're bullish, right? We're waiting for price to pull back into a high probability area where the bias is most likely to play out. And then obviously the final layer, which is, one of the most important part, is understanding liquidity. So we layer it with liquidity. That is the mechanical way, we use it to help us refine the idea even more, right? And time the execution properly. Now, once all these three pieces are aligned, that's when the trade idea becomes clean and actionable. That's when it becomes a high probability trade. Also, it naturally leads into your entry model, right? And from there, you're in the position and you manage the trade, right? But here's the key point. Entries and trade management should be the last thing on your mind, because market structure is always the first thing I look at, right? It's the foundation of everything I do in the market. And that is going to be the focus of today's session, right? We'll start with the basics for a few minutes to make sure the framework is clear, right? But if you're a bit more advanced, a bit more intermediate, don't worry. We'll move into more advanced structural concepts very, very quickly. Just stick with me for a moment and then we'll get into it. Okay, now what we're going to do is we're going to start with the bullish market structure first, okay? In a bullish market, or in other words, you can call it uptrend as well, it will actually consist of higher highs and higher lows, right? In a bullish market, that's what's happening, okay? Now, the objective is always in a bullish market to create these higher highs and higher lows, okay? It's pretty simple. Every time we get, a break of structure like this, a bullish break of structure in this case, meaning price breaks past the previous swing high, your first thought shouldn't be that, the price is going to run like this forever, because that's not the case, right? Price just doesn't move in one direction all the time. It will have what we call the pullback bit, right? The retracement part, okay? That's what the price is going to give you. Now, once price is broken past the high, okay, your thought process should be that we should be looking for some sort of pullback, okay? Now, obviously, this is in combination with other things as well that we're going to talk about in the future, liquidity being the main factor. You need to understand the context, but just know that once a swing high in a bullish market is broken past, you can expect some sort of a pullback, some sort of retracement, okay? Now, a break of high tells you that at some point this retracement is happening. So instead of actually chasing the momentum, instead of actually, just looking for longs or the buys, you should, prepare yourself to trade the pullback. You can be looking for some sort of sell position, because that's where, you can find, the pullback opportunities. Now, after the price breaks past the swing high, the low that caused the break of structure, that caused the break, becomes the new swing low, right? In this case here, once this low here pushed the price higher to break past this higher high, this low here then becomes a new swing low, okay? That's important because now you can map, basically your range, okay? Now, your range here, I'll talk about the previous range that we had, right? We had this high here, and then we had this low here, right? What did the price do? This lowest point pushes the price higher and creates a new high, okay? So now your new range is this lowest point here, okay? This swing low, which pushed the price higher to form a new high, and this new high is basically your swing high. So these 2 points basically is, your new range. Okay, anything that is happening within this range is internal. We're gonna, dive a bit deeper into that, the forms of, the types of structures. We're gonna go deeper into that, but right now just understand that your range becomes this low here, this one, and this high here. Let's say you're getting into some sort of buys from this point here. What can you target? You can target this weak high, that one that hasn't proven any strength yet. Okay, it's not holding because price, clearly broke past it. Okay, now in a bearish market, it's literally the same but opposite. Okay, you in a bearish market, the objective is to create lower highs and lower lows, right? That's the objective of the market in a bearish trend, right? In a downtrend. Now, when the price is bearish, it's printing lower highs and lower lows. Once you see a break of structure happening like this to the downside, a break of structure to the downside, once you see that happening, you need to stop thinking that it's going to, dump like this forever. Okay, and you need to start thinking, okay, we had the break of structure, now the pullback is most likely going to happen. So you can expect the price to make a pullback, right, into some sort of a zone. After a break of structure, the high that caused the break of structure becomes your new swing high. Okay, so this high here, let me just get rid of these lines here just to keep it clean. This high here, right, becomes your new swing high, and that high is your new strong structure. Because why is it a new strong structure? Because it's responsible for breaking past, creating a new potential low. Okay, and if you genuinely, if you can genuinely drill this into your head and apply it over, large sample size, you'll find yourself on the right side of the market more often than not. And trading becomes simpler, understanding what the price wants to do becomes simpler, the noise cuts down, the friction cuts down, and your trading becomes more smooth. Now, this is quite a basic diagram, right? The market is a bit more messier, it has a bit more noise and character to it. Okay, now let's say we're bullish. Okay, like you can see here. Now, if we're in a bullish market, okay, and we get a swing break of structure, which is this one here, right? The expectation doesn't change. Again, we expect a pullback, right? Break of structure again, pullback given, right? Break of structure again, most likely a pullback is waiting to happen. Okay, and what do? When we're expecting the pullback to happen, we are expecting the higher low, right, which is the strong point, because it is actually responsible for giving us the break of structure, right? This point here is responsible for giving us the break of structure. Similar, this point here is responsible for giving us the break of structure. We're expecting this point to hold. Now, what does that mean? That once the price has given us a break of structure, right, the price can retrace back towards the low. And if you are someone that can trade the pullback, can trade the retracement, 100% that is your move to take. Otherwise, you wait for the retracement part to finish, and then you can catch the next expansion leg, right? Next big move. Now let me take it a step back, because this part is very, very important, right? Before the break of structure. Now let me take this a step back, okay? Because what I'm going to tell you now is a bit important, okay? Before the break of structure, right? Let's suppose from this low here, before price gave us this break of structure, right? Price was trading inside an old swing range. And what was that range? That was this high here, right? So you had this high here and this previous low here. Okay, so it was actually ranging between these 2 points, a defined swing high and a defined swing low. Now, once we get a new break of structure, which is this one here, okay, the range shifts. We're no longer inside this old range. We have now created a new range. What is this new range? This new range is this low here and potentially this high here. Your first thing should always be, after a break of structure, where is my new swing low? Now, when you're marking it, your first question should be, where is my new swing low, right? That is your new swing low. which is responsible for the break of structure, and that is your new swing high. Okay, so this here actually becomes your new range. Okay, now here's the rule we use. Okay, in a bullish market, the true swing low, which is this one here, all right, is the lowest low that caused the break of structure. Why am I not marking this as my new swing point? Why am I only taking this one, right? Because it is the lowest point in a bullish market, the lowest point that caused the break of structure of the previous swing high. That is why this level here matters, and then once price has created a new high, that level matters. Okay, that becomes your new range. Now sometimes it's obvious, right? Like this, it quite simple diagram. It's quite obvious what the new range is. Sometimes it's a bit messier, okay, especially when you go and hop on the real chart. That's when it becomes a bit more complex, because there's a bit more noise, there's a bit more friction in the price. Okay, now what we're going to do is I'm going to show you an example on the live chart, okay, so you can actually understand how to mark your structural points if you're unsure, or if you're just getting started, how to actually be right all the time. Okay, now for that you're going to have three things as your best friends when you're marking your structure. Okay, first is going to be your trend line, right? Second is going to be your highlighter tool, and then you're gonna have the weak magnet on. Okay, so it snaps onto the candle, because we're aiming for precision. Okay, now what happens here is we're gonna mark, let's say we're gonna mark our structure points at this point here. We're gonna take the horizontal line. What we're gonna do is we're going to mark our range first. Okay, the way we're going to do it is we're going to mark our swing high here, okay, because we know it's a bullish market, so that's our swing high, and we're going to mark previous swing low, and the previous swing low is somewhere around here. Now once you have marked your range, the lowest point inside of this, right, inside of your range, is your new swing low. This point here is basically the lowest point that has caused the price to push higher and also give us what? A break of structure. So that is your new swing low, right? That causes the price to push higher and give us a break of structure. Now this range is used, right, because a break of structure has been given, so we're not going to actually utilize this anymore, right? We're going to delete this, and we're going to actually mark our new range. Now our new range is the new swing low, okay, so that's our new swing low right there, and then a new swing high, right? How do we know which one is the swing high here? You're going to see where the price has started to create a bit of retracement, okay, the pullback. Remember the one that we spoke about? We're going to have to look at where the pullback is starting from. If I'm looking at the new swing high where the price actually started to make a bit of a pullback, this is going to be the new point, right? This is the point which caused a bit of a pullback, so that becomes my new swing high, right? So this is the new range now that I'm dealing with. Now once you've identified your range, what you got to do next is you got to find the lowest point, right? The lowest point between this range that is actually causing the price to go higher. Now if I'm looking at this range here, the lowest point inside the box is this one here, right? This is the lowest point before the price actually pushes higher and breaks past the previous range. And then the cycle just repeats. Okay, once we've identified the range is giving us a break of structure, we're going to move on to the next range. Okay, now the lowest part, right, that's your new swing low, right, and the highest point before the retracement started to happen is your new swing high, which is basically this one here. Okay, this becomes your new swing high, right? Why is this my new swing high? Because after price gave us a break of structure, this is the point where price started to give us a bit of a pullback. What is the lowest point again? In between this range, which is responsible for the push higher. This, in between this range here, this is the lowest point, right? That caused the break of structure, that caused the price to actually push higher and form a new higher point. Once this range is done, once you've identified your swing low, once you know the price has given us the break of structure, the previous range is not going to be of any use to us. Okay, so we're going to get rid of that, and then we're going to create a new range, right? Now, this is your swing low, the new swing low we identified, so that is becoming your swing low range. And the swing high is where price actually started to give us a bit of a pullback after the break of structure. So the break of structure happens here. Once that is given, what's happening? We get a bit of a pullback. So this becomes your new swing high. Okay, this becomes your new range, right? Now, which part is the lowest part in this range here? The new swing low before the next push up, and that is this swing low here. Okay, once this swing low has made the pullback, right, has created the low, your new range immediately changed, right? Once the break of structure is given, it immediately changed. Now your new range is this low here and this high here. Now once price breaks past this one, your range changes again. This is your new swing low, right? Price broke past this structural point here, this higher high here. Once price breaks past it, you're going to see what's the highest point before we started to get a bit of a pullback. And the highest point here is this high here, right? So your new high becomes this point here. That's your new range. Okay, and then we can keep on, going, creating new ranges, new higher highs, new higher lows. But this is for you to just understand, right? That once you've marked that, everything becomes more clear. You know your range, you know your expectation, you know exactly what price should and shouldn't do. And that is what allows you to stay aligned with structure instead of, reacting emotionally to every small move. Now, what we're going to do is we're going to talk about the types of structures that are there, because there's external points, there's internal points, right? There's points where price is moving in between a range. So we're going to study that a bit, right? And this is where things start to make a bit more sense. The main thing you need to focus on first is the swing structures. That's basically your big picture. Your main swing high, which is basically this one here, okay? And your main swing low. And obviously, all of this, the pullback in between. Now, if you've watched, the markets for any amount of time, you've probably seen this happen. That price makes one strong move, right? One impulse move, sometimes almost straight down or straight up, right? And that creates a large range. It creates a bit of a range, okay? Now, when you've got a big range like that, price doesn't just move cleanly from one side to the other side, meaning that once price has created this range, it's not just going to make, a pullback to create a big range again. It doesn't happen, right? Or if it happens not very often. What it does is once it's created this range here, it starts to move in smaller moves, smaller trends. That's where a lot of people get confused. That's where, the noise kicks in. That's where, the structures don't come across very clean. So what we need is a very simple way to deal with that. A way to understand basically what price is doing inside the big range, inside these two swing points. And that is, understanding it without actually losing sight of the overall direction, because that's what we're going to build on next. Now, the next layer we want to look at is the internal structures. Now, the next layer that we got to look at is basically the internal structures, because like I said, there's two types of structures within the market, right? You have external and then you have internal. Okay, external, you clearly know these are the two swing points, right? Now we're going to focus on the internal ones, in the internal structure, right? And this is basically what the price is doing inside the main swing points, inside these 2 points. The price will start to create smaller range within the bigger move, and these smaller swings are what we call internal structures. This one here, the one that I've marked in with the black dot, that's your internal structures. Now think of it this way, right? Think of it as the swings inside the swing, okay? The smaller highs, which is this one here, the smaller lows, all of these are forming between the main high and the main low. This is what allows us to understand how price is moving within the bigger picture instead of just reacting to every smaller move. Now, just looking at this one here, we have our swing high, which is the strong swing high. Why is it a strong swing high? Because it is responsible for the break of structure to form a new low. Once that is done, price starts to range in between these 2 points and starts to create internal swing highs and lows, right? So you had a higher high, a higher low, gives us an internal break of structure. Why is it internal? Because again, the range is this one here. So anything that is happening in between this range is going to be internal. Okay, so internal break of structure, price pushes higher, gives us a bit of pullback to create a higher low, then gives us another internal break of structure, carries on doing the same, makes a pullback, higher low created, right, to give us another internal break of structure. Okay, it is still respecting the external swing high. Even with this push up here, it is still respecting that, right? So it's still internal of that range. Now, what is happening here is that once price has created this internal higher high, the trend starts to shift, right? You had an uptrend, which is starting to become a downtrend now. It gave us an internal break of structure to create a lower low, right? Gives a pullback, creates a lower high, which pushes the price down to give us another internal break of structure, pullback, push down again. Now this point here finally, gives us the push down to cause an internal break of structure and also to break past the range low. Now if I'm marking my next move, once price is broken past the previous lower low, and let's say price starts to make a bit of a retracement, the range that I'm going to be dealing with, okay, is not going to be this anymore. It's not the previous one anymore. What is going to be now is the highest point, right, within this previous range that caused the break of structure to happen. So my new swing points, right, my new swing external points would be this one here, okay, this one here, and this one here. Okay, that becomes my new range. And then whatever happens between this range here becomes internal of that before, we get a push down where price breaks past this swing low. It's as simple as that. We don't need to complicate it, right? You have external structures, you have internal structures, you have ranges, and that's it. It's as simple as that. Now, just doing that alone already gives you, the kind of multi-time frame view, okay, without even changing the time frames. But we don't stop there, okay? That's not the level we're aiming for. When you start properly combining multiple time frames with the 2 layers of structures, right, external and internal, that's when things really click. That's what consistently keeps you on the right side of the market far more than not. All right, so let's break that down and dive into how to analyze multiple time frames together. And the easiest way to basically understand this is on the candlestick chart, right? And is to think about how candles are built, right? One daily candle is made up of 6 4-hour candles. And you can check it for yourself as well. If you go to the daily time frame, you pick out any day, then you come down the time frame and you go down to H4, you'll see that you will have 6 H4 candles that are forming that daily candle. Or if you drop down even more, you go down to H1, you will see you will have 24 of those forming the daily candle. So the lower the time frame you drop down, on M15 time frame, there would be, I think, 96 candles. What was happening here is the more detailed price action you're seeing, that's actually forming one single candle on a higher time frame, right? That is why time matters, why higher time frame also carries more weight. Now, it's a given thing that time is power. Monthly price action is going to matter more than weekly, right? Weekly holds more weight than daily, and it just goes on like that all the way down to the second space. The higher the time frame, the more significance it has, simply because it takes, more liquidity, more orders, more capital to form price on those time frames. And as you drop down on the lower time frames, you're dealing with less money and more noise. That's where things start to, look a bit random if you don't have context. Now we're gonna go more in depth about time frames, the alignment of it, how to bring it together in the later stages. But right now, right, what I want you to do is just understand the basic relation, why the high time frames matter more when it comes to understanding the direction, and why they weigh more than um, you know whatever candles are showing on the lower time frame. Okay, now let's just focus in this part here, right? We're just going to focus on the swing points here and the two time frames: a higher time frame, right, which is in thick black line, and the middle time frame, which is basically in blue line. Now let's say line is your H4 chart, right? And we're in a bearish market. So price is doing what? Price is creating lower highs, right? And lower lows. Lower highs and lower lows. Then we have, a temporary bullish shift, okay? Because we have a break of structure here of the last swing point, and then price prints higher highs for a bit of time, okay? So you have higher highs and higher lows, and after that price shifts again back to bearish again, creating lower highs, lower lows, lower highs. Now if we just focus on this one leg of 4-hour price action, now if we're just focusing on one leg of 4-hour price action, I say we're just focusing on this leg here, it looks like a straight single line, a straight single move, right? But when we drop down to M15 chart, what do we actually see? We see that there's a full trend playing out. You have lower highs, lower lows, forming internally, right? So there's a full trend playing out. And this is important because it helps you understand the relationship between time frames. When the 4-hour is in a bearish run, okay, the job of the lower time frame is to support and fulfill the higher time frame objective. The job of the lower time frame or the middle time frame, right, is to support and fulfill the higher time frame objective. The 15-minute chart will turn bearish as well in order to, facilitate the 4-hour chart, to complete that bearish move. Now the relationship between time frame is key to everything we do next, right? Now at some point we know that the 4-hour chart is going to make a pullback, right? It's going to have that retracement bit, it's going to have that pullback. So what's the lower time frame going to do? The lower time frame has to change the trend as well, right? So it was printing bearish, right? You had the blue line printing bearish, the middle time frame printing bearish, and then to facilitate the bullish move on the higher time frame, middle time frame also made a shift, right? You had internal break of structures happening and price was turning bullish. And at this point, yes, we can follow the bullish trend of the M15 and look for some sort of longs, look for to trade that pullback, right? But this is the key thing you have to understand. The bullish trend on the 15-minute chart is not meant to last. It's not going to be creating higher highs and higher lows forever. Why? It's because the trend on the higher time frame is showing us clearly that we are in a bearish trend. So as soon as the 4-hour pullback is finished, right, what happens next? The 15 minutes is going to shift bearish again, right, along with the 4-hour time frame. So you're going to have break of structures happening here. The higher high, higher lows are going to convert into lower highs and lower lows. Now once you understand the relationship between the high time frame versus the middle time frame or the lower time frame, the price action stops being being random. It starts making a bit more sense. Okay, if there's one lesson, one thing I want you to leave with, it's this: that market structure is context, right? It's not a signal. Structure shows you, the narrative shifts. It shows you who is currently in control. It shows you whether, price is expanding or retracing. But it does not tell you where to execute, because execution requires context. You need, the high time frame alignment, clear swing framework, you need liquidity awareness, you need supply and demand positioning, and then, only then, does the execution part becomes logical. Now here's what I want you to do next, okay? Go open your charts. Don't look for trades, all right? Don't look for entries. Just mark your swing highs and swing lows. break of structures, pull back, higher time frame versus the lower time frame relationships, and start training your eyes to see the narrative shift, right? Not setups. Practice this on at least 15 to 20 charts, replay, mark, review, and that's exactly how this will actually click. I hope you've enjoyed this and learned a thing or two, and I will catch you in the next one.